Good day, everyone. Today, I will be discussing the important accounting standard, which is PFRS 15, revenue from contract with customers. This standard provides a comprehensive framework that governs how and when revenue should be recognized. It was developed to address inconsistencies in previous revenue recognition standards and to provide a unified model across different types of transactions and industries. The goal of PFRS 15 is to ensure that entities report useful and transparent information about the nature, timing, and uncertainty of revenue and cash flows from contract with customers. Before diving deeper into the standard, it is essential to understand the distinction between income and revenue. According to the conceptual framework in accounting, income is a broad term that refers to any increase in economic benefits during an accounting period. This may result from inflows or enhancement of assets or decreases in liabilities, which lead to increases in equity. Other than contributions from the owners, it includes things like gains, investment, income, or other one-time benefits. Revenue, on the other hand, is a subset of income. It specifically arises from the ordinary activities of an entity such as sales of goods, rendering of services, interest, royalties, and dividends. So in simpler terms, while all revenue is income, not all income is considered revenue. Revenue only refers to the recurring or operational earning of a business, those related to its main business purpose. Although PFRS 15 is comprehensive, there are specific transactions that it does not apply. These are governed by the other standards because of their unique nature. This includes lease contracts, which are handled under PAS 17 or the updated PFRS 16, insurance contracts, which are governed by PFRS 4, financial instruments, such as investment or loans, which are under PFRS 9. Non-monetary exchange between entities in the same line of business, like bartering transactions between two oil companies, are also excluded. By clearly defining what is outside the scope of the PFRS 15, it prevents overlap and confusion with other specific standards, ensuring consistencies in how financial transactions are treated. Next, applicability of PFRS 15. PFRS 15 is applicable only when there is a contract with customer for goods or services. Two key concepts needed to be understood. A contract is an agreement between two or more parties that creates enforceable rights and obligations. It can be written, oral, or implied based on customary business practices. A customer is a party that has contracted with an entity to obtain goods or services that are outputs of the entity's ordinary activities. This means that if there is no contract or no clear customer relationship, PFRS does not apply. PFRS 15 does not apply. The focus is on transactions where the entity expects to earn consideration in exchange for satisfying specific promise to transfer goods or services. Next is the 5-step framework. PFRS 15 introduces a 5-step model that entities must follow to properly recognize revenue. This model replaces previous rules-based approaches and instead focuses on the principle of transfer of control. The 5 steps are: Step 1. Identify the contract with the customer. Step 2. Identify the performance obligation within the contract. Step 3. Determine the transaction price. Step 4. Allocate the transaction price to each performance obligation. And Step 5. Recognize revenue when or as the entity satisfy each performance obligations. These steps are designed to reflect the economic reality of the transaction and help ensure that revenue is recognized in a way that matches the delivery of goods or services with the customer. So the first step is identify the contract with the customer. A contract is valid under PFRS 15 when the following criteria are met. The contract has been approved by all parties involved. The rights and obligations of each party are clearly identifiable. The contract has commercial substance. Payment terms can be identified. It is probable that the entity will collect the consideration it is entitled to. Even if a contract is signed, revenue cannot be recognized until performance has begun or there's evidence that the agreement will be fulfilled. If neither party has performed and both can cancel the contract without a penalty, then the contract is not valid for revenue recognition under PFRS 15. The concept of collectability is important because revenue should only be recognized if it is probable that the entity will be paid. Second, identify the performance obligation. In this step, we need to identify the performance obligation in the contract. These are the promises to transfer distinct goods or services to a customer. A good or service is considered distinct if, first, the customer can benefit from it on its own or with other sources that are readily available, and second, it can be separately identified from other promises in the contract. For example, if a company sells a laptop and offers setup services, those could be separate performance obligation if the customer could have bought each item individually. However, if the goods and services are highly interrelated or integrated, they may be bundled together into one combined obligation. This step is important because each performance obligation may be satisfied at different times, affecting when revenue is recognized. Now we proceed to step 3. Determine the transaction price. Under PFRS 15, the transaction price is not simply the fair value of consideration received as we used to follow under PAS 11 or PAS 18. Instead, it is defined as the amount of consideration an entity expects to be entitled in exchange for transferring promised goods or services to a customer. This expected consideration may come in various forms. It can be fixed, a set amount agreed upon in the contract. It can be variable, which means that the amount may change depending on circumstances like sales volume or performance. Or it can be a combination of both fixed and variable. This means, when setting the transaction price, we need to account for several components. Let's break down the first two components. First, variable consideration. This refers to the amounts that may change based on the future events. For example, performance bonuses, sales discount, rebates, refund, and price concession or penalties. To estimate variable consideration, the standard allows two methods. Expected value method, where you sum the probability weighted amount. Most likely amount method, where you choose the single most likely outcome. However, we must also apply a constraint. We only include a variable consideration in the transaction price if it is highly probable that there will be no significant revenue reversal later on. Non-cash consideration. This refers to the payments made not in cash, but in other form like goods or services. The entity must measure this at fair value. If fair value cannot be reliably determined, the fallback is to use the standalone selling price of the goods or services received. Next, we'll look at two more components in determining the transaction price. Time value of money. This becomes relevant when there is a significant financing component in the contract. For example, if the customer pays in advance or after the goods or services have been delivered, the entity must adjust the transaction price to reflect the present value of the expected cash flow. This ensures that revenue reflects the true economic value of the transaction. The applicable interest rate should be represent the credit characteristic of the customer. If the interest rate in the contract does not reflect the market conditions, then an implied rate must be used instead. Consideration payable to customers. These are amounts the seller gives back to the customer, such as cash rebates, discounts, and promotional payments. These payments reduces the transaction price and therefore reduce the amount of the revenue the seller recognizes. In simple terms, if you give money or incentives back to your customer, you should recognize less revenue. Now let's move on to step 4. Allocating the transaction price to performance obligations. When a contract includes more than one performance obligation, the total transaction price must be allocated to each obligation based on their standalone selling prices. The standalone selling price is the price at which the entity would sell or service separately to a customer. This means if the items were sold on their own and not as part of a bundle, that would be a standalone price. For example, if a company bundles a phone and a subscription plan, they will need to allocate the total contract price between those based on their individual prices if sold separately. However, what happens if the standalone selling price is not directly observable? In that case, PFRS 15 allows the use of estimation techniques. These are 3 main methods. Adjusted market assessment approach. This involves evaluating the market and the competitor's pricing, then adjusting the price based on your entity's cost structure or desired margins. Second, expected cost plus a margin approach. Here, the entity estimates the cost of fulfilling the obligation and adds a reasonable profit margin. Third, residual approach. This is used only when the price of one or more items is highly variable or uncertain. You subtract observable standalone prices from the total transaction price and then the remainder is allocated to the uncertain item. Last step, recognize revenue when or as the performance obligation is satisfied. Revenue is recognized only when control of the good or service has been transferred to the customer. This can happen in one of 2 ways. First, point in time. This means the customer obtains control at a specific moment. Indicators include the customer now has the obligation to pay, the customer has legal title to the asset, the entity has transferred physical possession, the customer has a significant risk and rewards of the ownership. Second, over a period of time. In some contracts, performance occurs gradually, and revenue is recognized progressively. This applies when the customer receives and consumes the benefit as the work is performed. Example, cleaning services. The customer controls the asset as it being created. Example, building a customized asset. The asset created has no alternative use, and the entity has the right to payment for the work completed to date. This step ensures that revenue is recognized in the line with the actual performance of the seller and the transfer of the control to the buyer.